Okay, it's about that time to get started, so we'll dive right in. First and foremost, I want to thank investing.com for having us today. It's a great honor, and this is a new service that they're offering, and we're excited to be a part of it. Today's class is actually part one of a three-part segment. I also want to thank all the attendees out there today who took the time to come and hopefully learn something about trading commodities that maybe they didn't already know. I know it's been, the month of August has been probably the most boring month in the markets in history, so it's hard to stay tuned to these sorts of things, but we're glad you're here. So today we're going to talk about stocks versus futures, or more specifically ETFs versus futures when it comes to commodities, and which is the best venue for speculation. There's obviously some debate. What I'm going to tell you is my opinion, and this is what I believe, and what I've learned throughout my years in the industry. That said, I am also a commodity broker, a futures and options broker, so my opinion might be a little biased. So keep that in mind as we go along, but I truly believe everything that I'm going to tell you today. If you don't know me, my name is Carly Garner. I work for DeCarly Trading in Las Vegas, Nevada. If you have any questions, comments, or concerns about today's presentation, you can contact me. There's my phone number and email address. If you're on social media, check us out at Carly Garner on Twitter. We're also on Facebook and Instagram. If you just do a search for Carly Garner or DeCarly Trading, we'll come up on any of the social media networks. And if you're not aware of some of the things that I do and I've done, I am a broker at DeCarly Trading. And again, we're a commodity brokerage firm, futures and options. I'm a strategist. I write a lot of analysis for the commodity markets for various sources. You may have, if you watch Mad Money with Jim Cramer, you might have seen our work there. I also write a column for Stocks and Commodities magazine. And I write a couple of in-house newsletters that our brokerage clients receive for free. So I stay pretty busy. I'm also an author. I've written 4 books on trading commodities. The newest book, Higher Probability Commodity Trading, came out last month, and we're really excited about it. It's the one book that I've written that is intended to be kind of the end-all, be-all, whether you're a beginning trader or a more advanced trader. We really think you'll find something useful and helpful in the book. So if you're interested, you can check out the website, Higher Probability Commodity Trading book.com. It's on Amazon. You can get it at any major book outlet, but it's usually the best deal is on Amazon. And before we get started on what we're going to talk about today, I want to remind everybody that there is a substantial risk of loss in trading futures and options. It's not suitable for everybody. There are no guaranteed profits. There are no, as we're going to learn later, when we're trading commodities, there really are no dividends or interest. It's pure speculation, and it's not easy, that's for sure. So today we're going to be basically asking ourselves, is there an optimal venue for trading commodities? In my opinion, there is, but let's talk about why I might think that. When most traders think of commodities, whether it's crude oil or the grains, corn, soybeans, metals, gold and silver, they tend to look for something convenient, and what they tend to do is they flock towards what they know, and what that is ETFs, and that's because they don't have to open a new account. It's right there with their stockbroker. They just log in, whether they're trading shares of Apple or IBM or whatever the case is, they can also just go ahead and buy a commodity ETF and gain exposure that way. And I agree, that's extremely convenient. But the downside of that is it's not necessarily efficient. Commodity ETFs are highly inefficient. In fact, most commodity ETFs are actually based on futures and options. Like, in other words, futures are the underlying product of the ETF. But what the problem is, the ETFs have to rebalance their funds, they have to pay for management fees, they have to pay transaction costs, contango rollovers, and all of these things add up to really result in a very inefficient product. I've seen times where natural gas moves 10, 15%, and the ETF moves 2 or 3. So you know, it's not always that dramatic, but sometimes you can get some really big discrepancies in the performance of the commodity versus the performance of the ETF. Another thing we're going to talk about is usually if you're going to trade commodities, even if you do decide you want to use futures instead of ETFs, which is what I highly recommend, but you have to use them the right way. We've all heard horror stories about futures and margin calls and all these types of things, and trust me, if you don't know what you're doing and you're unfamiliar with leverage and those types of things, it can come back to bite you. And so that's what we're for, is to hopefully help you and guide you through some of those things. But something to be aware of if you do decide to trade futures, you probably don't want to do it with your stockbroker. I know some stockbrokers, some of the big houses, they call them broker dealers, do offer futures trading on the side. However, it's maybe not as great of a deal as you think it is. It's basically, I mean, the best way I can describe it is they're a stock brokerage firm. They're offering futures trading on the side just simply because they want to retain the market share, but it's really not what they do. It's not their thing. They don't have a staff that's experienced. They don't have a staff that's knowledgeable in those products. And so it's kind of like one analogy I like to use is it's like going into a Chinese restaurant and ordering a cheeseburger. They're going to serve you a cheeseburger, but in the end, it's really not going to be satisfying. It's not going to be what you want or need. It's going to look and resemble a cheeseburger, but it's not going to be that great. So to make sure that we're all on the same page here, let's talk about what are futures contracts. And I'll make this quick because I know a lot of you are familiar with futures, but for those that aren't, a futures contract is a legally binding and standardized agreement to buy or sell a standardized commodity, specifying a quantity and a quality at a set price and a future date. Now that's a lot in one sentence, I get that. But basically what we're saying is if a futures contract is an agreement to buy, let's say, crude oil at a specific price. So let's say that somebody trading crude oil today might pay, we'll just round it and we'll say $48 for a futures contract that expires 30 days from now. That person is saying, I agree to buy the underlying crude oil commodity at $48 30 days from now. And what makes futures contracts so special is that they're standardized. They're all the same quantity, they all have the same characteristics, the same grade, the same delivery preferences, all of those types of things. So there's no difference between one futures contract to the next, it's all the same thing. And that's important because it makes it very easy and liquid to buy or sell. So again, standardization allows traders to easily transfer positions at any time before expiration. Without standardization, it would be necessary for each individual to find someone to take the other side of their trade to negotiate a deal. So in other words, if you wanted to speculate on crude oil or hedge crude oil or maybe even invest in crude oil, and the futures markets didn't exist, for you to make a transaction, you'd have to go out somewhere, somehow, and find someone else that's willing to take the other side of your trade. Well, luckily, because we have the centralized exchanges, it's really easy to find someone to take the other side of the trade. Because everything is standardized and everything is known and transparent, people can see the prices, people can see the contract specs. It's as simple as clicking a button. And because of this ease of buying and selling, the futures markets are extremely liquid. And because of that liquidity, the futures markets are an extremely efficient way to speculate on commodity prices. Now you'll hear people say, well, what about when crude oil was $150 and speculators pushed the price higher? Now keep in mind, even though the markets are efficient, they can be wrong. And so there's a difference between being efficient and wrong. And on top of that, it's absolutely true that speculators probably drove prices higher than they should have gone in the late 2000s or mid to late 2000s, but it goes the other way as well. If you remember earlier this year, crude oil was trading in the high 20s. It probably should have never been there. So just like it shouldn't have been at 150, it probably shouldn't have been at 28 earlier this year. Those are the types of things that happen, unfortunately, in markets. It's not necessarily a question of efficiency, because eventually, markets can stay overbought or oversold, and they can go to extremes temporarily, but they usually don't stay there. They'll usually revert back to some sort of realistic level. Futures contracts are deliverable, and that's really why the price of crude in the futures market is reliable and is useful to those trying to hedge crude oil in the cash market. It's true, only about 3% of all futures contracts actually result in delivery of the physical commodity, but because they are tied to the physical commodity, the price changes are extremely similar. So in other words, if futures contracts weren't deliverable, if they were just contracts that were intended to be based on crude oil pricing, there wouldn't be anything linking crude oil futures to the cash market, and you might see some really big price discrepancies. But you don't see that because eventually, if you hold a futures contract long enough, you will go into delivery and you will take delivery of the underlying commodity. Now, I'm being really simplistic when I say these things. The average Joe could not take delivery of crude oil. It's illegal. But maybe if you were trading corn, yes, you could. If you had the money to pony up at the end of the contract and you held, you theoretically could take 5,000 bushels of corn. Most futures market participants, though, they're simply speculating on price. If they're bullish corn and so they buy a contract, but to offset it, they sell it. Or if they're bearish corn, they might sell a contract, but to offset it, they buy it. The great thing about commodities, unlike stocks, is that people can buy or sell in any order. If you're bullish, you buy. If you're bearish, you sell. It doesn't matter. You don't have to own it first. If you're trading stocks, you either have to own the stock before you sell it, or you have to borrow it from your stockbroker, and you have to pay him interest to do it. So in commodities, you buy or sell in any order. It's instant. The bid-ask spreads are tight. You simply click the button of a mouse, or if you have a broker, you can call your broker. The main difference between stocks and futures is one is an asset and one's a liability. And let me explain what I mean by that. When you're buying a stock, you're purchasing ownership of a corporation. That's an asset. You're purchasing a piece of any of the assets that corporation has on the balance sheet. You're also purchasing a piece of any future dividends, if there are any. But when you're buying a futures contract, you're simply entering into a contract to make or take delivery of a specified commodity once it goes into expiration. That's actually a liability. You don't own anything. When you go long corn, you don't own corn. All you own is the liability to accept delivery of corn if you held into the end of the contract, when the contract expired. Now, I don't want anybody to be scared of that. I know this audience is probably more inclined to be stock investors as opposed to commodities, which is why we're here trying to teach about futures and options. And if that's the case, don't be scared about somebody delivering you 5,000 bushels of corn and going into delivery, because I've been doing this for a long time. I've been doing this since 2004, and I can tell you I've never had a single client take delivery, unless they wanted to. If you want to, that's a different story. Most clients do not. It's not something that just happens. First, before it gets to that point, your broker would send you an email or give you a call and say, hey, you need to roll this into the next contract month. So it's not going to happen to you unless you're on vacation for a month and you just, you don't pay attention to anything. And even then, I would guess your broker would probably just retender your obligation. So that is not something. There's a lot of things to be scared of in commodity trading, but that is not one of them. You should never be scared of getting delivered upon. It's not going to happen unless, your broker really, really, really drops the ball. So let's talk about some of the similarities and differences between futures and stocks. I'm going to go through the list real quickly here, and then we're going to talk about them in detail. The similarities, it's a pretty short list. Basically, they're both exchange traded, and they're both the speculative vehicles. But beyond that, stocks and futures are massively different. And it's important to understand this. A lot of traders really simply don't. And like I mentioned before, a lot of beginning traders will log into their stock account and they notice, hey, I can now trade futures with my stockbroker. And so they just think that it's that easy. They start clicking buttons to trade futures when they really have no idea what they're doing. And trust me, that is a bad combination. There are a lot of differences between stocks and futures that you must be aware of before you get involved. One of the main differences we just talked about is ownership. Remember, a futures contract is a liability, but in stocks you actually own something. It's an asset. Another big difference is time horizon. Stock traders tend to think, when they think long-term, they're thinking 5 to 10 years, but a futures trader, their idea of long-term might only be a couple of months. So there's a really big difference in the way traders look at things and the way the market behaves accordingly. A lot of that is because futures contracts are leveraged and futures contracts expire. And if you're not familiar with leverage, leverage is simply the ability to purchase more of an asset or more of the underlying commodity than you actually are putting money down for. So let me explain that a little better. The margin on crude oil right now is, we'll just round it and say it's $4,000. But if you're trading crude oil, you're actually trading roughly $48,000 worth of crude oil. So you can imagine you're only putting down about 10% of the contract. It's not unlike a mortgage. When you buy a house, maybe you only put down 20% or 10%, whatever it is your down payment. But the money that you put down is making or losing based on the entire value of the home. So if you buy a $300,000 house and you put down $20,000 and you go to sell it, if your house went up by $30,000, you actually almost more than doubled your money. But if the price of the house went down $30,000, you not only lost your $20,000 plus another 10. So that's leverage. If you're putting a small amount of money down to gain exposure to a much larger asset, you have leverage. In the stock market, you can trade on leverage, but you have to borrow money from your broker to do it, and you have to pay him interest. In the futures market, everybody gets leverage, and it's free. There's no cost to leverage. We're going to talk about that a little more. Tax treatment is favorable for futures traders. We already talked about how you can buy or sell in any order for futures traders. And again, we're going to go over these in a lot more detail. I'm just kind of giving you the overview here. But futures traders face lower account minimums, better margining, expanded hours, much more efficient when it comes to commodities, and but one thing that we've got to put in the category of an advantage of being a stock trader is dividends. Now that's not true of the ETFs. So if you're trading commodity ETFs, there are no dividends. But if you're trading the underlying commodity stocks, or let's just say, like for example, gold miners or energy stocks that are actually operating companies that, you know, their profit and losses are tied to the value of the underlying commodity, but it's truly not a pure commodity play, obviously, but they do pay dividends. Okay, let's talk about the advantages of futures, commodity futures. You can buy or sell in any order, and this is awesome. As a commodity broker, I've come to the point where honestly I don't even think twice about selling something first before I buy it. And if I think a market's going down or my client thinks a market's going down, they simply sell it. Stock traders or beginning investors have a hard time grasping this because it seems a little weird to sell something before you own it, but in commodities you can do just that. And it's extremely efficient. So as a beginning stock trader, your goal might be to buy low and sell high. But as a commodity trader, you might have that goal, but you might also have the goal of selling high and buying low. And it's that easy. There's no extra permissions. There's no extra disclosures to sign. There's no interest to pay. So the great thing about futures contracts, and I'm going to clarify this just a little bit, futures traders are granted free leverage, and they're granted a lot of it. That said, leverage is a double-edged sword. Just because you're provided a lot of leverage doesn't mean that you have to use it, and in fact, you probably shouldn't. So we're going to kind of go through the leverage and margin situation again real quick. To trade futures, traders must post a margin requirement. It's a good faith deposit. And Leverage is provided by the market and the exchange, not the broker. So just keep that in mind, and there is no charge for it. So let's assume that we just kind of mentioned this before. If crude oil has a margin of, we'll round it to 4,000, and crude's trading at, this slide was obviously made a little earlier this year, but crude oil's trading at, we'll call it $45 a barrel. The contract is valued at $45,000. So if you have $4,000 in your account, you can trade $45,000 worth of the commodity. You can imagine how quickly you would make or lose money. You know, if you're right or wrong in the commodity by 1%, you're talking, you know, a good chunk of change in return in regards to percentage on your margin available. Now, keep in mind, if the margin on crude oil is 4,000, that doesn't mean if you have 4,000 in your account, you should put 1 crude on, or it doesn't mean if you have 8,000 in your account, you should put 2 crudes on, because you want to leave a little room for error. There are margin calls that come into the mix. If you lose in crude, I think the maintenance is probably somewhere around 3,200. So if you lose a little and your account balance dips below the maintenance, you're going to get a margin call. So it's not like you can go long crude with a $4,000 account and just let it ride forever, because it's leaving it a little tight. Ideally, you want to only use half or less of your account towards margin. So if you're trading a $4,000 margin crude oil, you probably want to at least have about $10,000 in the account. Of course, this is an opinion. Some people trade with much more leverage, and some people trade with less. One thing to point out is you can take leverage out of the markets by simply overfunding the account. So if you have $45,000 in your account and you trade 1 crude oil future, you're basically trading with no leverage. And again, leverage is great because it supercharges profits, but it also supercharges losses. You want to be careful with that. Stock traders must pay interest to their broker for access to leverage and margin accounts. And to get a leverage or margin account, generally brokers or stock brokers require that you have 50 to 100,000 in the account. Some of them even require more. So imagine a commodity trader could come in with $5,000 account and get more leverage for free than a stock trader could get with a $100,000 account. Again, I'm not saying it's all good. You want to be careful with it. Leverage is a dangerous thing, but it's nice to have that option and that choice. Commodity futures trade expanded trading hours. Most futures markets are liquid almost 24 hours a day. Aside from an afternoon pause, which is about an hour, traders can easily execute orders around the clock without any inconveniences or restrictions. And there's generally tight bid asks around the clock. So a crude oil trader could wake up at 2 in the morning and buy or sell crude oil with a single click, do it efficiently. But a stock trader would probably have to wait for the morning open on the New York Stock Exchange. And guess what? Prices can move pretty dramatically between 2 o'clock in the morning to 8 or 9 o'clock U.S. time, Eastern Coast time. So market access is a big, big thing. So as we discussed, futures traders are buying and selling agreements that are written against the actual commodity. Thus, they're exposed to extremely efficient price changes. This is in stark contrast to commodity sector stocks, miners, oil companies, which face company-specific risk other than noise. So for instance, what I'm trying to say here is if you are bullish gold and you're thinking of buying some gold miner stocks, that's great, that's true. Those miners probably will benefit from gold prices going up, but the problem is you're also going to have company-specific risk. If something specific happens to that company, you know, who knows, some sort of natural disaster, could be anything, but it would negatively impact your investment, even though you could have been right about the direction of gold. So if you really are truly speculating on gold, I believe it's a good idea to do it in the commodity itself and to do it with futures contracts. ETFs really do not follow the price of the underlying commodity as much as we'd like them to. It's a great idea because ETFs do pull the leverage, well, some of them, unless you're trading leveraged ETFs, but basic ETFs do not provide leverage to traders. So it basically pulls the leverage out of the market, and that's good because not everybody can handle leverage. I live in Las Vegas. Not everybody can live in Las Vegas. Some people just can't handle it. So ETFs are a great way to kind of keep your emotions in check and keep yourself under control, but it doesn't come without a cost, and that cost is efficiency. Futures traders enjoy very small barriers to entry. I know at our brokerage firm, it depends on the trading platform and so on and so forth, so it's not a simple black and white answer, but generally speaking, there really is no account minimum. And on some of the platforms that do have minimums, it's only $2,000 or $3,000. So you can get involved in futures trading in commodities with a relatively small amount of money. And the great thing is there are very small futures contracts available. For instance, there's an E-micro gold contract, which is only 10 ounces of gold. So somebody with a small account could easily speculate in gold using a little leverage, but nothing overbearing. There are mini grain contracts, mini corn, mini wheat, which we and our clients use all the time. It's a great way to get involved in the markets without being exposed to ridiculous leverage and ridiculous volatility in your account balance. So again, we mentioned this just a few minutes ago, but I want to make sure you understand. Stock speculators wanting to swing trade and day trade with leverage are generally required to have a pretty sizable account, 50 to 100,000. And I hear a lot of times people just assume that the commodity markets are riskier than stocks. So someone might be tempted to put something other than risk capital to work, trading stocks on leverage, but guess what? Stock trading can be really, really risky as well, especially when you build the leverage into it. The one thing I can say about commodities is even though market participants often abuse the leverage, and I regretfully say that, I wish that wasn't the case, but a lot of people tend to push their limits simply because they can, and they can do it for free and conveniently. But the reality is commodities really cannot go to zero like a stock can. So if you're not abusing leverage and you're doing all the right things in regards to risk management, maybe commodity trading isn't necessarily as risky as people point it out to be. I'm not saying it's easy. I'm saying maybe it's, maybe we're trained to believe that it's out of our reach because it's too risky, and maybe it's not. I talk a lot about this, risk management, leverage, properly funding an account, position sizing, and all those sorts of things in my book, Higher Probability Commodity Trading. And we emphasize the fact that the markets can really be anything you want them to be. They can be a casino if you want to purely gamble, or they can be an investment if you pull the leverage out and take a slower approach. So it's not necessarily the markets that are risky, it's the market participants' behavior that's risky. If you've ever followed any of the classes or articles or anything that we've done over the years, you know that we tend to be advocates of option selling. I believe that option selling is a relatively high probability venture in relation to other strategies. Again, doesn't make it easy, and there's no guaranteed money, but I do think it puts the odds in your favor. The problem with option selling for many is they just simply don't have access to it. Stockbrokers will probably require 50 to 100,000 in an account to even consider getting option selling access. But options on futures traders can have a relatively small account and sell options. I mean, for example, 5 to 10,000 is enough to sell options on commodities. And another big difference is not only do they have to not have the big account to initiate a short option trade, but stock traders, a lot of brokerage firms will require that they have enough money in the account to cover the event of being exercised on the options. Even though being exercised isn't necessarily a high probability event, it can happen. Sometimes we're talking hundreds and hundreds of thousands of dollars required to be in the account just in case on the off chance the options are exercised for stock traders. But in commodity accounts, it's not like that because the underlying product, the futures contract, is also leveraged. So you don't have to have these big cash outlays to sell options and commodities like you do stocks. A lot of stock traders work hard to get to a position to where their brokerage firm will grant them portfolio margining. It requires generally You know, every broker is different, but stockbrokers generally require $100,000 on deposit. They generally require that you fill out a special application telling them how experienced you are and those types of things. But all futures accounts, all commodity futures accounts, regardless of size, experience, so on and so forth, are granted portfolio margining. And this is great because what portfolio margining is it takes all the positions in your account and nets the risk together and then comes up with a margin requirement. So if you're selling strangles, if you sell a call and a put, you're not paying margin on both sides of the trade because you can't lose money on both sides of the trade. You can only lose money on one side of the trade. If you're trading option spreads, you're not going to be margined on the short options without being given a credit for the long option, and so on and so forth. So portfolio margining is really, really key, and it's easy to get for commodity traders, but not so easy to get for stock traders. Now, because futures contracts expire, it is necessary. You cannot simply buy a futures contract and hang on to it forever. So if you're bullish gold, you can't buy a gold future and just hang on to it for 5 years. That's not how it works. Contracts expire in gold a few times a year. When the expiration comes up, you have to sell the contract you own and then buy a new one. So it's not really a big deal. They call this rolling over, and it's just kind of the cost of doing business in commodities. But it does affect the way that you hold for the long term. So for example, if you're planning on holding a position for 2 years and you have to roll over 5 times in those 2 years, you have to keep in mind each time you roll over, you're probably paying the contango, which is the difference between the price and the contract you're getting out of and the price of the contract you're getting into. In some situations, that can be pretty substantial. And you'll also have to pay a transaction cost, which is probably pretty minimal. But it is a bit of a disadvantage. A huge advantage of trading commodities in the futures markets over ETFs or stocks is the tax treatment. This obviously doesn't apply to those outside of the U.S., but if you're in the U.S., futures traders receive favorable tax treatment. There's a 60-40 blend between long-term and short-term capital gains, and this is important because long-term gains are taxed at a lower rate than short-term gains. So it doesn't matter if you're day trading or scalping, you're only in a position for a minute. You still get taxed at a 60-40 blend. Now, of course, if you're losing money in your account, this does you no good. But if you're making money, it's a great benefit. And it's also a heck of a lot easier to report to the IRS if you're a futures trader. A stock trader or an ETF trader would have to list each and every transaction, how much you made or lost on that particular transaction, and you send all that to the IRS. But in commodities, you only get one number. At the end of the year, your broker will give you a 1099. It's going to tell you how much you made or how much you lost, and that's it. You report it to the IRS and you're done. So it's easy peasy if you're a commodity trader. If you're a stock trader or an ETF trader, it's not so easy. You're probably going to have to hire somebody to do that for you. Okay, obviously, as I mentioned before, I'm a commodity broker. My opinion's a little biased, but I'm not ignorant. I do understand that there's definitely some advantages to trading stocks over futures, and here's a few of them. Liquidity is a big, big factor in the commodity markets. Most of the major commodities are liquid, but to be honest, there's only about 30 futures markets liquid enough for trading, and of those, probably only about 10 that are highly liquid that I would consider markets that should be on your rotation, something that you watch. Everything else can just be forgotten about. Forget about everybody wants to trade palladium or platinum or aluminum or lumber, but I'll tell you what, those markets are really difficult to trade because liquidity is not there, which means if there happens to be a big trader come through, he can move the market really quickly in the blink of an eye with absolutely no fundamental changes or any real differences on the outlook of the market itself. There are even fewer liquid option markets. So in some of the less popular commodities, options are so thin they aren't even an option. You shouldn't even trade them. They're listed. Like if you look at the exchange's website, you'll see options listed in some markets, but then look at the open interest and there's nothing there. You should never ever trade a market if the open interest is like 0 or less than I'd say less than 50 contracts, you really probably want to think twice about trading that market. Stock traders, on the other hand, enjoy lots of liquidity. There's thousands of stocks that are liquid enough to trade. There's hundreds or maybe even thousands of options that are liquid enough to trade. The other thing that the stock market can provide that the commodity market cannot is dividends. Futures do not pay dividends. There's no cash flow until the trade's offset, and there's no cushion to losses. This is obviously a disadvantage. If you're trading particularly the E-mini S&P futures, which is the stock market, the nice thing about it is it's kind of like trading a mutual fund with leverage, free leverage. So assuming that you're not overdoing it and you're putting yourself in a situation as far as overfunding your account to a point where you can buy the E-mini and just let it and hold it forever, you're probably setting yourself up for a pretty decent outcome. However, just keep in mind you are missing out on dividends, and dividends make a big, big difference. In a sideways market like we have now, anybody that's holding stocks and earning dividends is not, probably doesn't mind the market being this quiet. Okay, there's something to keep in mind. If you decide to trade futures, choose a brokerage service that specializes in commodities, and I really mean this. Don't go for the most convenient, which is, well, my stock account is here, I'll just trade commodities in my stock account, or trade futures in my stock account. It's convenient, but it's probably not the best choice. If you're trading with a specialized futures broker, you're going to have a lot of benefits. Some of them are not on this slide, but some of them are. You're going to see exchange minimum margin. A lot of stockbrokers that will let their clients trade futures charge them higher margin rates. So if you're trading with a futures broker, you're probably going to get exchange minimum margin. You're probably going to get lower day trading rates. With that said, I'm not a huge fan of super low day trading rates because the odds of success are not that great. If you're trading with way too much leverage and you simply are not leaving yourself enough room for error, you're going to lose money. It's really almost inevitable. But it's nice to know that it's there if you need it for a quick intraday situation, or maybe we're talking the flash crash. The difference, can you imagine being at a stockbroker that liquidated your position at the bottom of the flash crash right before the market recovered? Well, a commodity broker will be less likely to do that because they have a risk management desk that it's equipped to handle those types of events, and they know exactly how to handle them. So I'm not saying it can't happen at a commodity broker, but it's less likely. So you really want to make sure that you're trading with the right broker. Obviously, a specialized futures broker is going to have an experienced staff that will be able to answer your questions and help you out of a jam. This is extremely important. It only takes one mishap or one misunderstanding to really cost you a lot of money in the markets. You can lose a lot more money in the markets than you will ever pay in commission. That's my opinion. And probably the biggest advantage of working with a specialized futures broker is if you do get into trouble and you do trigger a margin call, a good broker will be able to give you some ideas on how to lower the margin without you having to liquidate your position or without you having to send more money. There's usually an adjustment using options to lower risk and lower margin that will work out. A stock brokerage firm probably won't even ask you about what your intentions are with the margin call. They might just go in and liquidate your trade. So if you're interested in learning a lot more about commodities, getting a lot more in-depth into market analysis, strategy development, risk management techniques, all those sorts of things, please consider picking up a copy of Higher Probability Commodity Trading. Again, you can find it at any bookstore, but preferably the cheapest, most efficient way to get it is through Amazon. And you'll find more information of it on our website, higherprobabilitycommoditytradingbook.com. And we appreciate all your support. We thank you for coming out today. If you have any questions, comments, or concerns, please feel free to contact us. And keep in mind, we have a lot of free educational videos and articles on our website, decarlitetrading.com. So we hope to see you there. Okay, looks like we have a couple of questions here. I'm going to try to answer these really quick. Okay, somebody's asking who we clear through. We Our commodity brokerage actually offers clearing through about 6 different firms. Most of our clients are clearing through Gain Capital. We also use ADM, Archer Daniel Midland, Rosenthal Collins Group, Wedbush, Dorman. This was recorded. Investing.com is recording this, and I believe it will be posted on their website. Okay, somebody's asking which markets that I consider liquid and highly liquid. Well, that's a good question. Here are the markets that I tend to focus on the most, and that's because they are liquid, and I feel like you're going to get the best price action. E-mini S&P, the E-mini NASDAQ, Treasuries, so the 30-year bond and the 10-year note. In the currencies, I like watching the euro, the yen, and I'll watch some of the others, the Canadian Aussie dollar, and maybe even the British pound for opportunities every once in a while. In the energies, you want to stick with crude oil and natural gas occasionally. The others, honestly, I think you're better off leaving alone. Heating oil and RBOB gasoline, they're pretty vicious when it comes to volatility, and the options are really illiquid, so it makes them difficult to speculate in. In gold and silver, if you're sticking to futures, they're very liquid. Silver options are highly illiquid. I think it's because the exchange lists too many strike prices. They list strikes every nickel in silver, and it spreads the volume out to so many strike prices that the bid-ask spreads are horrible. So I'm really not a fan of trading silver options. Somebody's asking about account minimums. To get onto our best free platform, the minimum's $2,500, and you could day trade the mini Dow or mini S&P with that. Day trading margins are about $500. Okay. Somebody's asking. Well, I'm not sure what they're asking. We'll go to the next one. Hold on. Someone's asking, can I trade from Mumbai, India? Absolutely. Every brokerage firm is different, but most brokerage firms, or at least most futures and options brokerage firms, will accept clients from all over the world. I know we have clients from just about any country you can imagine. Somebody's saying that options are easier. When I say futures or commodities, honestly, I'm referring to both futures and options on futures. We actually are big fans of option trading. I think it pulls the volatility out of the market. It gives traders more room for success, and I think it gives them better odds of success. So, and actually, that's exactly what my new book is about. Is all about using options to help your futures trades. So it might mean selling options against your long futures. It might mean buying options to protect your futures, or it might mean just trading options outright. Somebody's asking, what's the best way to trade commodities? Well, that's an open-ended question. There are about as many opinions on the best way to trade commodities as there are people. So everybody's different. The thing is, you want to find what works with your personality, and what I mean by that is the difference between making or losing money in the markets, I believe, is mental. And so if you are trading a strategy that you're not comfortable with, or you're trading with too much leverage, then you're honestly asking for trouble, because you are putting yourself in a position where you're going to panic, you're going to make bad decisions, you're not going to think clearly. So the best way to trade commodities is the way that you're most comfortable with, and if that means starting really, really small and trading e-micro contracts, then that's what you should do. Simon's saying he's a newbie and he's looking for a certain firm that can make recommendations and that sort of thing. And yes, absolutely. Actually, DeCarly Trading is our brokerage firm. We provide our clients with newsletters that include market commentary, trade guidance. We'll give specific recommendations. We offer broker-assisted accounts for somebody that wants to communicate with a broker and ask lots of questions. And we really don't have a minimum. I recommend at least $2,500 to get onto our best free platform. And to be honest, if you want to give yourself a good shot at making money, I think you probably want to try to shoot for $5,000 to $10,000, but it's up to you. You should always start with whatever you're comfortable with, regardless of which brokerage firm you choose. Okay, I think, yes, absolutely. Somebody's asking if we accept non-U.S. investors. Yes, absolutely. We have a lot of non-U.S. investors. We are open to opening accounts from almost anywhere, so we certainly do. Somebody's asking if we trade bonds. Yes, I love the Treasury markets, the 30-year bond and the 10-year note. We follow very closely. Actually, I write a newsletter every day about it. about those two particular markets. And we've done some, this year we've done some option selling in the 10-year note, simply because it's a low margin, and I don't want to say safe, because safe is not the word. The 10-year note, any market can be dangerous at times, but generally speaking, the 10-year note is relatively tame. Somebody's asking when's the best time to trade crude oil. Well, crude oil is basically priced in US dollars, and so the most liquid session is the US session, and that runs from about 9:30 a.m. Eastern time to, well, it probably gets illiquid probably somewhere around 4 o'clock Eastern time. So from 9:30 to 4 o'clock Eastern time is probably the best time to trade crude oil. Somebody's asking if there's contract fees like ETFs. No. In crude oil futures, or whatever commodity you're trading in the futures market, you pay when you purchase or sell the contract. When you enter the trade, you pay a commission plus some exchange fees, which are a couple bucks. But then you don't pay anything else until you get out. So there's going to be a transaction cost on the way in and a transaction cost on the way out, just like any other security. It's commission, but you don't pay any other fees. No management fees, nothing like that. You're purely speculating on the price of crude. You're not paying any management fees or anything like that. Okay, I think that does it. I think we've answered all the questions. If you have any others, feel free to send me an email. I'd love to hear from you. And I appreciate you coming out today. Thanks, everybody.